The mutual fund industry had a dream run in the last 6 to 7 years. The asset under management of the Indian mutual fund industry grew from 8.25 trillion rupees in March 2014 to an all-time high of 28.3 trillion as at the end of February 2020, more than threefold increase in a span of around 6 years, equivalent to a CAGR of 23%. However, the outbreak of COVID-19 and the subsequent volatility in the markets led to an AUM decline of 17% between February and April. In our ideas for profit today, I will discuss about two AMC stocks, that's HDFC AMC and Nippon Life, to see if these really warrant investors' attention. Nippon Life India Asset Management Firm, one of the largest AMCs with mutual fund assets of over 2 lakh crore rupees as at the end of March, has posted muted performance in FY20 and also has lost some market share. Now, mutual fund AUM declined by 12% year on year, driven by outflows in the debt funds and also the decline in valuation of equity assets due to a sharp fall in equity markets in March. Now, despite the tepid revenue, operating profit actually increased by 8%, driven by a fall in commission and also the other operating expenses. Profitability was also impacted due to the fall in other income, and the AMC booked mark-to-market losses of 100 crore rupees in Q4 due to market volatility. Now, retail assets form 24% of its average AUM, much better than the industry's retail AUM of 19%. At the current market price of 239 rupees, it is trading at 7% of mutual fund AUM as of March. Now, in terms of PE metric, Nippon trades at 27 times FY22 estimated earnings. The rich valuation is partly justified given the ROE of around 16 to 18%, its strong retail brand and improving asset mix, and also well-diversified sourcing platform, but the upside remains unlikely. While we are quite positive about Nippon Life as the sole promoter and credibility, investors really need to see the company regaining lost market share and also a meaningful pickup in the asset growth before buying into the stock. Now, HDFC AMC, on the other hand, continues to be at the forefront in growth in the mutual fund assets, now retaining its dominant position in the industry with market share at 13.7% in terms of the overall assets under management. The AMC delivered a strong growth in the profits in FY20. The profit was, however, impacted by a mark-to-market loss of, say, 120 crore rupees on the SL Group papers held on the AMC's books this time around. Now, while the quarterly average AUM grew by 8% year on year, in FY20, the AMC saw its closing AUM at the end of March 2020 declining by 7% due to a steep 23% fall in the Nifty during the month of March. Now, asset composition and the customer profile are key determinants of profits in the asset management business, and HDFC AMC enjoys a favorable mix in both these variables as of now. Now, additionally, performance, trust, and also distribution reach are equally important in attracting investors. HDFC AMC scores well on these parameters too. Now, the business performance continues to be strong despite macro headwinds such as the slowing inflows and also the tepid equity outlook. It is precisely this ability to outperform even under such difficult conditions that makes HDFC AMC stock quite expensive. But despite the premium valuations, investors should keep HDFC AMC on their radar. Now, this is because amidst the virus-induced chaos and after the Franklin debacle, one thing is clear. A few powerful firms are set to gain more clout, and HDFC AMC is one such name. Investors shouldn't be surprised if smaller AMCs cede market share in favor of HDFC AMC, akin to larger private banks garnering deposit market share from the smaller private banks. Investors should therefore look for a price correction to buy into the stock.